I screen hundreds of mid-cap stocks looking for exceptional businesses, and Wall Street is currently pricing this essential government partner like a stagnant survivor. They are panicking over a delayed paycheck from Uncle Sam and completely ignoring the real story. This business is quietly using artificial intelligence to decouple their labor costs from their transaction volumes, and their margins are rapidly expanding because of it. Let's look at what the market missed. Maximus is a pure-play provider of government services. When a state or federal agency needs to manage Medicare eligibility, run a massive contact center, or update their digital health systems, they hire Maximus to do the heavy lifting. What makes this interesting right now is that the stock is trading at a severe discount. The market is selling off over a cyclical revenue comparison and a temporary cash flow delay caused by a major federal customer. It's a classic overreaction, offering us a high-return franchise priced like a value trap. The beauty of this business is the recurring revenue. They don't sell one-off widgets. They administer ongoing welfare and health benefits. Most of the pie comes from U.S. federal services, followed by state-level U.S. services, and a small slice from international health assessments. And they have a massive $59.1 billion sales pipeline waiting in the wings. Their competitive position relies on absolute low-cost positioning paired with massive switching costs. By deploying artificial intelligence in their contact centers, they are actively breaking the link between how many people they employ and how much volume they can handle. Fragmented state IT departments and smaller peers simply can't match that operating leverage. We are looking at a $3.20 billion company with 54.81 million shares outstanding, operating in the industrial sector. Let's talk about what could go wrong. Maximus relies entirely on government spending. If legislators cut Medicaid budgets or shift policy, contract volumes shrink. They also carry a heavy debt load that makes them sensitive to rising interest rates. Plus, there is always the fear of losing a major client, like the upcoming Veterans Benefits Administration recompete. But what is really driving the sell-off right now is a temporary working capital strain. A major federal customer had some complex retroactive invoicing requirements. That pushed their days sales outstanding up to 78 days, causing a massive temporary drain on cash. Add in a cyclical dip in revenue from lapping last year's natural disaster support, and the market panicked. Here is what the panic sellers are missing. That delayed paycheck, it is a funded government contract. Uncle Sam is good for the money, and management expects collections to catch up by year-end. As for the fear of digital disruption from competitors, Maximus is already disrupting itself. Their margins are actually expanding as they roll out their own automation tech. The business is fundamentally strengthening. Let's calculate the real cash this business generates. We begin with the cash they actually pulled in, $411.78 million in operating cash flow. Next, we subtract the real cost of stock-based compensation, which was $38.53 million. We deduct this because paying employees in stock is a very real expense to continuing owners. Then we address the working capital. Because that massive drag was just a temporary federal invoicing delay, we add back $188.36 million to neutralize it, treating it as a timing issue rather than a permanent cost. Next, we subtract their 5-year average maintenance capex of $82.13 million. We use the smoothed average because it accurately reflects the routine IT upkeep required to service existing contracts. We subtract $0 for working capital reinvestment. After all the real costs, this business put $479.48 million in our pocket. When we divide that total by the 54.81 million shares outstanding, we get true owner earnings of $8.75 per share. The capital efficiency here is staggering. Maximus generates an exceptional true internal earned rate of 54.40% on its tangible assets. While return on invested capital sits at 11.62%, the real story is their asset-light model. Because their equipment is mostly software and contact centers, their 5-year average maintenance capex is just 1.54% of revenue. They require almost no capital to grow. Their competitive advantages show up right in the margins. Gross margins sit at 23.83%, and operating margins have expanded to 10.81%. That competitive trajectory is strengthening as artificial intelligence continues to decouple labor costs from transaction volumes, creating serious operating leverage. This is a reliable compounding engine. Over 5 years, revenue has grown at a 9.43% annual clip, and that operating profit margin is up 234 basis points compared to its 5-year average. The balance sheet is the one blemish we have to respect. They carry $1.62 billion in total debt against just $244.70 million in liquid assets. That leaves them in a net debt position of negative $1.38 billion. But watch where the cash is going. Management is heavily prioritizing shareholder returns. As their primary capital lever, they deployed $447.48 million into annual net buybacks. They are acting as intelligent cannibals by shrinking the share count at a steep discount to intrinsic value. They also paid out $68.71 million in dividends. Let's run this through our investment checklist. Do we understand it? Yes. It's a straightforward business process services provider handling essential government plumbing. Are the economics durable? Yes. Processing government healthcare eligibility is incredibly sticky, and the returns consistently exceed the cost of capital. Do they have honest management? Yes. Instead of chasing foolish acquisitions, they are aggressively repurchasing their own undervalued stock. Is it an attractive price? Yes. The market is entirely focused on a temporary working capital anomaly, offering us a wonderful business at a steep discount. Here is the math. We take our normalized owner earnings of $8.75 per share. We apply a conservative 15 times multiple, which is highly appropriate given the extreme predictability of government-backed cash flows and their exceptional returns on tangible capital. Then we subtract the net debt burden of $26.04 per share. That gives us an exact intrinsic value of $105.21 per share. With the stock trading at $62.21, Mr. Market is offering us a substantial margin of safety of 42%. My verdict is a clear value opportunity. We have an asset-light, high-return franchise trading at a steep discount because the market is fixated on a temporary cash flow delay and a cyclical revenue comparison. There is no fundamental structural problem here. The economic moat is widening through technology, margins are expanding, and a shareholder-friendly management team is aggressively shrinking the share count at bargain prices. Thanks for watching. Remember, this is just a starting point for your own research. Never buy a business just because someone on the internet told you to. Stay rational, stay informed, and consider subscribing if you want to walk through more deep value setups like this one. See you next time.